The CFPB's recent report reveals who's applying for reverse mortgages, where they live, and how much they earn. Stay tuned for details.
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
The CFPB, or the Consumer Financial Protection Bureau's most recent release of data from the 2019 Home Mortgage Disclosure Act, or HMDA, submissions is both enlightening and perplexing. If you are unfamiliar with the Home Mortgage Disclosure Act, it was created back in 1975, and it gathers loan-level data from lending institutions to help ensure that the lenders are, in fact, serving the housing finance needs of their communities. And late last month, the watchdog agency released an update to their review of HMDA data, and it includes new data points which were captured in 2019, that is, during the calendar year 2019. And of course, with the reverse mortgage being a niche of the larger mortgage market, you'll see that much of the data in the report is, of course, focused on the traditional mortgage lending market. But don't worry, we're going to go through and give you the most salient and important points. But the reported reverse mortgage data does give us some really good insight into our market's demographics, the applicant's financial health, and more. But before we dive in, let's keep these three things in mind as we proceed. First, the report is counting applications, not endorsements. Second, the data is reported for the 2019 calendar year. So that makes any comparison to the 2019 fiscal year somewhat problematic. And third, let's talk about terminology. When I say a mean value, that's the sum of a set of numbers divided by the number of numbers in that set. So for example, the mean value of 10 entries of a numerical total of 100 is 10. And a median number is merely a number that's stuck in the middle of a data set. So think of it as median, meaning middle. So let's begin our review of the HMDA data with demographics. Nationally, 74% of all reported reverse mortgage applications were for non-Hispanic white applicants, 7.2% for Black or African American applicants, 4.4% for Hispanic whites, 1.7% for Asians, and approximately 10% were missing an ethnicity being entered on the application or listed as others. And of course, the distribution of the races is going to really depend on the location. So that depends on the application activity area. Next, some have long argued for many years that the reverse mortgage is just a loan of last resort for those that are house rich and cash poor. But the HMDA data would appear to contradict such an assumption, and it shows that 37% of all reverse mortgages are originated in high-income neighborhoods. Middle-income neighborhoods account for 44% of all applications, while the low or moderate areas only account for 18.7% of mortgage loan activity. So with 80% of reverse mortgage applications coming from the middle and higher income neighborhoods, perhaps it is time to put the loan of last resort myth to rest once and for all. However, let's not overlook there is a remarkable difference between reverse mortgage applicants and those in a traditional market. For example, the traditional HELOC applicant versus a reverse mortgage applicant. Well, the median income of a HELOC applicant is $107,000 versus a modest $28,000 for a reverse mortgage applicant. And the report adds this: which are the lowest among borrowers of all enhanced loan types, perhaps reflecting the unique design of the reverse mortgage to help income-constrained seniors convert home equity into cash income. I would correct that and say cash flow, not income. The percentage of reverse mortgages that are fixed versus adjustable is somewhat skewed in the HMDA data when we compare it to recent CFPB reports on reverse mortgage lending. So the HMDA report says that 48% of all reverse mortgage applications were for fixed rate loans. Contrast that with HUD's 2019 report to Congress on FHA's insurance fund. That shows that 94% of all endorsements were adjustable rate HECM loans. That disparity would seem to indicate either that there are reporting errors or challenges in how that data is collected and submitted. And while the financial assessment has been worrisome and continues to be for some originators, the average or mean credit score of 749, a FICO score of 749, would seem to indicate that most of your applicants have a strong history of on-time payments and few delinquent accounts. But there's one big caveat. Of the 32,000 plus reported loans in the HMDA data, only 2,100 reported a credit score. So that's a very small sample size. It represents only 6% of all applications. A more complete data set would be quite illuminating on credit scores. And next are interest rates. Critics continue to decry that the reverse mortgage is exorbitantly expensive. However, the median interest rate that was charged in 2019 was 4.48%, as the reported median traditional home equity line of credit, or HELOC, interest rate is 5.34%. A home equity conversion mortgage's line of credit actually seems to be a legitimate competitor to the HELOC, if not a better choice when the payment terms are considered. So in conclusion, how can you benefit from all the data that we're looking at in this HMDA report? Perhaps you're edified being more informed of the unique borrower profiles, incomes, and the loan types that are being chosen in the market today. Of all the information that you put into a 1003 uniform residential loan application, you're going to see that it goes far, far beyond your processor and underwriters. So what are your thoughts on this most recent report and data? You can leave those in the comment section below. Please share this video with other reverse mortgage professionals. You can do that using the social media links found on this page. If you're on YouTube, be sure to subscribe. That way you never miss an upcoming episode. Thanks for joining us for another week of news, commentary, and analysis here at HighIncome World. I'm your host, Shannon Hicks, signing off, and we'll see you next week.